This lecture is going to be on the history of Forex. That's going to be on the page called A History of Forex, right there. And let's begin. Forex, or foreign exchange, has a long history going all the way back to biblical times. Back then, commission was charged to change money for people. Then, moving on to the 4th century, the Byzantine Empire has managed to create a monopoly on currency exchange. Then fast forward all the way to the 15th century, the Medici family opens banks in foreign countries to exchange currency, and they did this predominantly for textile merchants. Then in the 17th and 18th centuries, currency trading spread. Amsterdam made an active foreign exchange market, and agents conducted transactions from England, Holland. Then the gold standard monetary system was created in 1875. What this did is that it made governments guarantee that their currency would be able to be converted into gold. This required governments to have a substantial amount of gold reserves. Pretty soon all the major economic countries were on this gold standard. Then in 1913, half the world's foreign exchange was conducted with the British pound, and the amount of banks, forex banks in London, went from 3 to 71. Eventually, governments wanted to print more money than what they had in reserve in gold, and so the gold standard wasn't really working that well anymore. This started in World War I and then happened again during World War II. This brings us to the Bretton Woods Accord in 1944. The Bretton Woods Accord allowed currencies to fluctuate within a range of 1% to the currency par. It also made the US dollar the prime reserve currency in the world, replacing gold, and the US dollar became the only currency in the world backed by gold. The Bretton Woods Accord also created 3 international agencies. These are the IMF, the International Monetary Fund, the International Bank for Reconstruction and Development, and GATT, G-A-T-T, which stands for General Agreement on Tariffs and Trade. Then in 1971, President Nixon abolishes the Bretton Woods Accord. He did this because the U.S. gold reserves was not enough to back all the currency in circulation. So much for that. And then in 1973, what happened? The Smithsonian Agreement allows currencies to trade within 2% range instead of the 1% previous. In 1981, China allows some people to trade currencies, and South Korea allows free trade of currencies. Then in the 1990s, banks create their own trading platforms, and most important to us, retail forex brokers create internet-based trading platforms. So just a couple of decades ago, we would not have been able to trade this market, but now we can. And that's what this course is about, how to trade this market successfully.